Personal Finance: How to Save, Spend, and Think Rationally About Money, adapted from Big Think. Managing personal finances can be a challenge, but approaching money with rationality and intention can lead to greater financial security and long-term wealth. Here are key principles and strategies for saving, spending, and thinking about money in a way that fosters financial well-being. 1. Start with your mindset. The way you think about money shapes how you interact with it. Adopting a growth mindset about personal finance is crucial. This includes understanding that financial habits can be improved over time and that setbacks are opportunities for learning. Here are some mindset shifts that can help. Value delayed gratification. Often, the most important financial decisions are about what you don't buy in the short term in order to build wealth over time. Avoid emotional spending. Impulse buys, especially in response to stress, can derail your financial goals. Work on recognizing the difference between needs and wants. 2. Create a budget and track your spending. You cannot manage what you don't measure. Creating a detailed budget is essential to knowing where your money is going and identifying areas for improvement. Break your budget into clear categories such as essentials, for example, housing, utilities, groceries. Non-essentials, for example, entertainment, dining out, subscriptions. Savings and investments, for example, retirement accounts, emergency fund. Regularly track your spending to ensure you stay within your budget and make adjustments as needed. Many people overspend in categories like dining out or online shopping without realizing it, and this often leads to financial stress. 3. Save first, spend later. Prioritize saving by paying yourself first. This means setting aside a portion of your income for savings and investments before you pay for discretionary spending. The recommended savings goals might include emergency fund. Aim to save 3 to 6 months of living expenses in case of unexpected events. Retirement savings. Contribute regularly to a 401k, IRA, or other retirement accounts to take advantage of compounding interest and employer matches. Short-term goals. Save for specific goals, such as a vacation, home purchase, or education. By automating these savings, you make it easier to stay disciplined and ensure that you are consistently setting money aside for your future. 4. Minimize debt and avoid bad debt. Debt can be a powerful tool for building wealth, but it can also be a heavy burden if not managed carefully. Pay off high-interest debt as quickly as possible, such as credit card balances or payday loans, which often carry interest rates of 20% or more. In contrast, consider taking on good debt for productive purposes, like a mortgage on a home or student loans for education that can lead to higher earnings in the future. However, always weigh the cost of borrowing against the potential return or benefit. 5. Invest wisely. Investing allows your money to grow over time. Start by understanding the basic investment principles: risk, return, and time horizon. 2 key strategies to consider. Index funds. These are low-cost, diversified investment options that track the performance of broad market indexes like the S&P 500. Over the long term, they typically outperform actively managed funds. Dollar cost averaging. Instead of trying to time the market, invest a fixed amount of money regularly, for example, monthly. This strategy helps to mitigate the risk of market volatility and reduces the impact of short-term price fluctuations. 6. Embrace the power of compounding. Compounding is one of the most powerful forces in personal finance. The earlier you start saving and investing, the more time your money has to grow. Even small contributions can accumulate into substantial amounts over time when compounded. For example, if you invest $100 a month in an account that earns 6% annual interest, you'll have more than $100,000 after 30 years. This illustrates the importance of starting early and making consistent contributions. 7. Consider lifestyle inflation. As your income rises, avoid the trap of increasing your spending proportionately. Many people experience lifestyle inflation where their spending increases as their earnings grow. Instead, try to keep your lifestyle relatively constant while increasing your savings and investment contributions. For example, if you get a raise or a bonus at work, consider using a portion of it to boost your savings or retirement contributions rather than splurging on luxury goods or experiences. 8. Prioritize financial education. To make informed decisions about money, invest time in learning about personal finance. Books, podcasts, and courses can help you build a strong financial foundation. Familiarize yourself with topics like investing, tax strategies, insurance, and estate planning, as these areas will help you make smarter choices and avoid common financial pitfalls. 9. Plan for the long term. While it's important to address your current financial situation, don't lose sight of your long-term goals. Create a plan for major life events like buying a house, paying for your children's education, and retiring. Set specific financial goals and regularly review and adjust your plan to ensure you're on track. 10. Mindful spending and quality of life. Spending mindfully means focusing on the things that truly add value to your life. Rather than spending on temporary pleasures, prioritize experiences and purchases that align with your core values and long-term goals.
For example, investing in your health, education, and relationships can provide lasting satisfaction and enrich your life for more than material goods that offer only fleeting joy. By implementing these principles, you can build a solid foundation for financial security. The key is to balance saving, spending, and investing in a way that suits your personal circumstances, while also considering your long-term aspiration. Rational thinking about money isn't about deprivation, it's about making informed, deliberate choices that align with your values and financial goals.